Hi, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast. We are thrilled to have you join us today while we continue to shelter in place and stay safe. Joining us is David Burrows, Chief Investment Strategist, and Jim Shitakis, Senior Vice President and Portfolio Manager with Barometer. During this webcast, we will provide a review of current market and economic conditions with a deeper dive into the healthcare sector and recent developments as leading scientists race to find a vaccine for COVID-19. As always, I encourage questions from participants via the chat, or please email me at phastings@barometercapital.ca. We will address your questions at the end of our webcast. With that, I turn the conversation over to David Burrows. Hi, David.
Hi, Pam. Hi, Jim. I want to thank everybody for logging on today and being a part of our call. We have lots of Barometer clients with us. We have some friends of the firm online today, and I want to welcome all of you. As we move further through this process, things are becoming a little more clear. Markets have certainly been doing the work that they need to do. There's lots of sorting going on. At the end of the day, capital does flow to the place where it's treated the best, and there are some very clear winners and some very clear losers, and we're going to sift through that a little bit today. As always, I want to talk a little bit about what we're finding in our proprietary research on market breadth, which really ultimately tracks flow of funds, where money is coming from and going to, and we'll work through the process. So just off the top, we have a view, excuse me just a second. That we've been through obviously a very tough decline in the market, 34% from top to bottom. And going through that process, our work was helpful in getting us to the sidelines and getting us out of some of the weaker sectors and sort of to the bottom of the market. The various strategies that we run had sort of muted declines, although still troubling. We've compared the decline much to some of the other waterfall declines in the past, for example, to the 1987 crash, which was of similar magnitude and over a reasonably similar length of time, although certainly different circumstances. We talked about the fact that when you get a waterfall decline after an initial bounce, the market tends to have to do a little bit of work and sorting to see who has been damaged and who maybe has had their business model accelerated. And certainly that is the case in this decline. But when a decline like that happens in a secular or long-term bull market, it tends to repair itself over the next number of months. In the case of 1987, it took about 20 months to go back to break even. We talked on the most recent call about the fact that our breadth models had shown some resiliency in the market after the sell-off took us to the point where only 8% of stocks in the NYSE had been immune to the selling, and we bottomed out in the end of March, similar to the bottoming out in 2008 in October. We got a great rally. And one by one, stocks joined the rally until about 2 weeks ago, we got to a point where 70% of stocks in the NYSE were participating, 30% were not, and then we had some pullback. If you looked at what the market had done, we got the initial technical bounce off the bottom, market pulled back. We had a couple of weeks of optimism that came from significant fiscal and monetary stimulus, and a slowdown in the COVID cases. And then we suggested the market had some work to do. And so from roughly the middle of April through the middle of May, market has sort of chopped itself sideways in a wide range. But that probably doesn't tell the whole picture. We're gonna go a little bit under the surface. Recently, at the end of last week, on a strong rally day on Friday, our breadth model once again reversed higher. So breadth again started to expand. Now, interesting, index level is roughly the same point it had been when 70% of stocks were in uptrends at this point, 46% of stocks in uptrend. So the market has been narrowing, fewer stocks participating, but still very clear leadership. And so this is where we sit. Most of the major indices are seeing some expansion in breadth. A lot of it in the key leadership groups, a little bit of it in some sectors that have not participated, really not enough to make major changes. So as we sit today on the close, interesting timing, it looks as though we are coming out of this range we've been in over the last month, and we closed at a new rally high for the S&P. So that is a positive. So we're seeing expanding breadth, we're seeing a consolidation resolving higher. That's a real positive. Certainly, there's been lots of jawboning on behalf of both central banks and governments to lend support. But we're also getting optimistic news. We're getting a slow reopening in many countries around the world, a little further ahead in Europe and Asia, but US states are coming in behind. If we look at the significance of the rally, we've had quite a significant rally, about 62% of the initial decline. And that's the S&P. Now, all the indices are made up a little bit differently. The NASDAQ, which we've heard a lot about, is trading very close to its old highs, probably due to the dominance of technology in the NASDAQ. If you took the industrials, about 50% advance off the bottom, of course, a little more economically sensitive. If we look at the Canadian market, it's similar to the Dow Industrials. It's recovered about 50%. And you can see on this relative strength line that relative to the S&P, it has been weaker. So less recovery in the Canadian market. And if you take the global Dow index, which is a broad index of stocks from around the world, you can see that it has been recovering. But in fact, just basically underneath the low from December of 2018. So the global recovery has been more anemic than the US. Of course, in the US, it's a very dynamic economy. It's a very dynamic market. Investors find ways of turning lemonade and lemons into lemonade. And certainly there has been some real strength. But of course, there's some really dominant industries in the US. So why is it that some indices are doing better than others? Well, it really depends on what you've got in them. The S&P, and more importantly, the NASDAQ, the largest sector by a lot is technology. And technology as a broad sector are making new relative highs versus the market. In other words, the technology sector has consistently been trading stronger than the overall market. And technology is a little bit misleading because really it's made up of so many different buckets. Now at Barometer, our strategy is to try to identify structural themes, things that are changing, industries that have a tailwind, where not only will their earnings grow and be more resilient, but as a result of the technical changes, they have a tailwind and investors are willing to pay a higher and higher multiple for those earnings as they make themselves more clear. And so underneath the mantle of technology, we can put a lot of different buckets, most of them doing extremely well. So of course, software, subscription-based software, making new relative strength highs versus the market. Lots of companies in that bucket, including Microsoft, which we own. Cloud-based companies like Google, making relative highs, almost back to the old highs. Of course, what we've been going through has enhanced adoption of cloud-based services as we have adopted distributed workforces. Cybersecurity, another bucket within technology. E-commerce, making actually new absolute and relative highs driven by companies like Netflix and Amazon. Solar companies, alternative energy, making new relative highs, another form of technology. Robotics and automation. Clearly, there's a tailwind here. We're trying to work with fewer in the labor force. And healthcare. Now, we're going to spend some time talking about healthcare today. We've got lots of different buckets you could focus in. Medical devices, of course, have done well over the last many years. Pharmaceuticals and biotech we're going to focus on today. There's the biotech sector making new absolute and relative highs. We're going to talk a little bit about that. The gold mining stocks and the gold sector have been on fire. In the most recent week, the silver stocks have joined into the rally with some big moves coming out of the larger companies like Silver Standard and Pan American Silver. And gold continues to make its way out of this base that it's been in, much like it did when it came out of the base around 2000, rallied straight through 2011. Now, there's obvious reasons for that. We've had lots of stimulus pushed in. But what makes us optimistic about the sector for the stocks is while the gold is performing quite well, the stocks have only just started to outperform the gold itself. So this is a ratio of gold versus gold miners. And the gold mining stocks tend to look a little bit further forward, and people are willing to pay a higher multiple, but there's a long way that these can rally before they even get back to old highs, which actually would be close to a double from here. So easy to understand why gold is rallying. There's an enormous amount of fiscal and monetary stimulus being pushed into the system. Some would say, as Fed Powell said this week, we don't actually print it, we digitally print it, and made it clear that they have really unlimited resources to try and fight this. So there's been a battle going on. We've got lots of cash on the sidelines. We've got investors who are quite defensive. We've had an enormous amount of Fed stimulus and government fiscal stimulus. On the other side, battling it out against some pretty weak economic data. So very strong spending, a little tough to pay for. So we're seeing printing take place. So just to put things in perspective, you know, clearly we all know the economic data is weak. US retail sales really sort of fell off a cliff, literally. This is putting it in context of many years. The jobless claims obviously way up. We've eaten up about 10 years worth of job gains in the US economy. Retail sales, you take a typical cycle since 1969, this is clearly different. Industrial production, significant decline. This is significantly different. Had the jobless claims, enormous. But what we are seeing is at the margin, these things, that the negative impact is becoming more muted. And it's the very beginning. So what's going to matter going forward for the market is how long it takes to get things reopened. Do we get a second wave? Do we actually hire back all these people? We have a theory that US businesses will take this opportunity to become leaner under the cover of the COVID virus. And it may well be that they will be much more profitable after the fact than they were going in, having taken significant cost-cutting measures. But the market is going to tell that story. What we do know is that investor positioning continues to be very cautious. There are not very many bullish investors. In the most recent reading, only 23% of investors are bullish. That's a positive because it means that they can be converted. 53% were bearish. And because of that, we know that positioning is quite cautious also. This is a chart that shows that investors or players in futures, S&P 500 futures, are significantly short the market. That means they're expecting the market to decline. Now the market continues to rally. It squeezes these people in to have to cover their shorts. If we look at a composite of indicators as to the futures positioning in crude oil, copper, equity indices, and then layer on top the inverse of positioning in treasury bonds in US dollars, we see again, investors are extremely cautiously positioned. So you've got strong fiscal and monetary policy, that's supportive. You've got defensive positioning, that's supportive. You've got weak sentiment, that's supportive. We've got lots of things to fight our way through, but the market's trying to look beyond the current to what may be on the other side. And maybe there's some clues here. Certainly the banks, which would bear the brunt of rate downs and solvency, are not rallying. So investors are staying away from the groups that would be most negatively impacted if this goes on longer. These would fall into the camp of broken, hoping to get fixed, as opposed to what we like to invest in, which is good getting better. Good, but with a tailwind and perhaps accelerating. Industrials fall into the same camp. Now, robotics, obviously a subset of this, acting very well. Utilities. Two groups are extremely crowded in the market, places that people went to be defensive and get a dividend. And at this point, they are not participating, likely overowned. Utilities have been relatively weakening versus the market over the last 2 weeks. And some of the holdings we had in utilities, we've reduced to step away because they're not participating. And same with real estate investment trusts. Obviously, there is concern around office space occupancy and retail occupancy. So we'll see what happens in the reopening. On the COVID front, very clearly, as it stands right now, things are continuing to improve around the world. And many of these countries are going through reopening, so there is yet to be any significant impact around a second wave, but we're going to watch this closely. So now the biggest swing factor going forward as to whether this is a short-term issue or something that's going to go on for a long time is going to be what comes out of the world of science. The biotech sector is telling us that investors are hopeful or people want to be involved. There's going to be winners and losers. And I thought maybe Jim could spend a little bit of time and talk about healthcare as it relates to the current market, what our expectations are, who's doing what, and maybe where we see some opportunity. Jim?
Thanks, Dave. This healthcare has been challenged over the last 3 or 4 years, largely because they've had this pricing overhang and regulatory overhang on their back. And what's changed here is that we have a healthcare crisis, and the pharmaceutical companies, the biotech companies, they are part of the solution. They're the guys wearing the white hats coming in to save the day. So all of these companies are working together in unprecedented fashion. You talk to the CEOs, the chief medical officers of these companies, and they're collaborating as they've never collaborated before. So, and how we progress in the reopening is going to depend on whether we have vaccines or treatments going forward. So this slide is just gives us a landscape of what vaccines are doing at this point, what the companies are doing within the vaccine sector. So on the horizontal axis, we have time. On the vertical axis, we have the potential capacity to produce. First out of the gate has been a small company that we have a position in on the top left called Moderna. The genetic sequence was released by the Chinese on January the 10th. On January the 11th, they were going at it full blast to come up with a RNA sequenced vaccine. And they were able to get into a phase 1 trial where they have it in humans in the middle of March. And they're complete on their phase 1 trial now. And we'll start phase 2 shortly and hope to be into phase 3, which is the registration trial, by the early in September, and potentially have capacity to produce over 1 billion doses in early 2021. So they were first out of the gate, small science company based in Boston. Then if we go down a little bit to the right is Pfizer with their partner. They have a similar kind of RNA vaccine, a similar timeline, just a little bit more delayed, maybe in the first or second quarter. And they expect to be able to produce at least 500 million doses in 2021. So a lot of potential coming. And then finally we have J&J on the top, and they're able to come again with a large number of doses, but it'll probably be later in the year. And these are all different vaccines, different shots on goal. So that's why when you hear some of the medical people talk on the news, they're getting somewhat comfortable that we're going to have some sort of vaccine because we have a lot of shots on goal. And increasingly, it's looking like the vaccines will have durability of about a year or so. So much like the flu vaccine, except have greater efficacy. So it's something that you'll have to take maybe once a year, once every couple of years, as opposed to the measles vaccine, which is once in a lifetime. Now, of those companies, Pfizer and Johnson & Johnson are the largest, and they're able to do something different. And that is that once they choose their target vaccine, they're going with a number of candidates. Once they choose, which they're going to do in September, they're going to start producing vaccine on the chance that it will be approved. So once it gets approved, they will have hundreds of millions of doses ready to go. Moderna is also progressing on that line and will have vaccine ready to go. They're producing at risk. So Moderna knows the compound they want to go with, so they've already started. They're building plants and they're getting ready to produce vaccine. So there's a lot of positive news on the vaccine front. We own, those are the three companies we own. The others are doing good science, good work as well. And we own them in different portfolios. So Johnson & Johnson and Pfizer, we can own in income-oriented portfolios because they pay a nice dividend. So it's a very, we're able to segment the portfolios according to the kind of company that we're looking at. Now, that's the vaccine front, and vaccines are going to take a little while. In the best case scenario, we're looking at, late fall, early winter, or early 2021. However, on the therapeutic side, so treatment, we're more advanced. First out of the gate was a company called Gilead with the product remdesivir that's been given emergency use authorization. They were running a trial, and it had to be stopped early because they found that the patients on remdesivir were getting out of the hospital 25 to 30% faster. So that's a number of, instead of being in the hospital for 2 weeks, they were in the hospital for 10 days. And that's a big improvement given that hospital capacity is crucial in this kind of pandemic. So that was the first line of defense. And remdesivir is an antiviral. And antivirals have had a mixed history of efficacy, and it's given in the hospital in an infusion, so it takes a little while. The next line of therapeutic is antibody treatment, and it's actually gotten to be a bigger company now called Regeneron, is working on a antibody cocktail. So the way your body fights off a disease, it sees that there's some virus and it develops antibodies. And the vaccines are trying to get your body to produce these antibodies. But the other thing we can do in terms of a therapeutic is design the antibodies and introduce them into the body. And that's what Regeneron is doing. And they've come up with an antibody cocktail. They hope to start trial shortly. And with some good fortune, they should have a registration trial going on in late August, early September. So potential for a treatment that takes the downside of the disease off the table. So it's a very encouraging, and there are other companies. Eli Lilly is working on a similar technology, but Regeneron is clearly ahead of everyone else, and they're very hopeful. Their chief medical officer was interviewed recently, and he was almost giddy at when they were able to put these antibodies together and found that it was working in vitro. So it's probably one of the best biotech science companies out there. They've been in business for 25 years or so, and the two guys that head up the company have owned meaningful shares in it and have been running it ever since, and have no desire to step away. They just love what they do. So it's one of our high confidence outcome companies. So this all brings a nice halo effect to the whole sector. So we have companies that are coming to the rescue of the economy, really. So that we have investments in a company called Vertex that is not involved in COVID treatment, but is the leader in cystic fibrosis. But that gives them the cover to say, okay, we're part of the solution as well. So when generalists are adding to their positions, there's a higher potential valuation metric that goes along with these companies now, because they don't have to worry about regulatory risk. They don't have to worry that that the government, and that's one of the few things that the Republicans and the Democrats agreed on, was that they needed to regulate drug prices. And that's the one thing that's off the table now. So all of the pharma sector, all of the biotech sector is untouchable in terms of their pricing ability. So it's a very encouraging backdrop to the investment horizon for these companies. And I know I get enthusiastic about this stuff because they're really doing good work and being rewarded for it. So it's nice to invest in these companies as opposed to some companies that blow things up.
So you should all know that Jim has been the one person holding down a chair in the Barometer office while we're all working from distributed workplaces. So we're going to keep an eye on you, Jim. We all saw the movie The Shining, and we hope you're fine down there at the office. Okay, so all of this to say that the evidence continues to support the fact that we are still in a structural bull market in equities. This is certainly a setback. There is some very clear leadership. We are focused in those groups. We are not focusing on groups that are not participating and that have a headwind. We're going to continue to watch the science. We're going to continue to watch the stimulus. It appears every time the market has a wobble, Steve Mnuchin or Fed Chair Powell jump on TV to tell us why things are going to be okay. That's fine so long as the market agrees with it. If the market starts to disagree and starts to misbehave, we have no problem getting defensive. We do think that we're headed into summer, and when we head into summer, often we get some bumpiness. We highlighted the fact that when you do have a waterfall decline historically, you do have some work to do, and you do get some post-bounce volatility, and that's not lost on us. So we're not out over our skis. We're going to continue to be flexible. We're going to continue to look for new leadership as it starts to emerge. We aren't seeing signs of new groups at this point, but the ones that we're in are acting just fine. Should things start to get a little more sloppy, our breadth models will start to show us, hopefully early, at the sector level and at the market level. And we've shown in the past no hesitancy to play defense. But for now, it's sort of steady as she goes, and we'll continue to work our way forward. So I want to thank everybody for taking the time to join in today. Certainly the weather's starting to get nice. Probably the last time I'm gonna have the fire on behind me. Jim made fun of me when I started up today. But certainly give us a call with any questions. Pam, are there any questions that have come in that we can address? You're muted.
Sorry about that, everyone. Dave, thanks so much. And Jim, thank you so much for joining us today. Your institutional experience speaks volumes, and we appreciate it, and so do our clients. Dave, really quickly, one thing that we keep getting asked from clients is, if there is a second wave, how are their portfolios going to be protected going forward? Maybe you could just really briefly touch on our disciplined leadership approach. I think our strategy and our style of protecting client capital could be elaborated on by you, just
Sure.
briefly, if you don't mind.
So look, first of all, we take the backdrop from our breadth models. And the reason we do that is because when markets start to roll over, generally the things closest to a problem or the weakest securities are impacted first, and then selling spreads and eventually gets the stronger stocks. So the most important thing that we can do is make sure we're in the stronger stocks and be in the sectors that are most broadly supported by the current condition. If things were to stay difficult, many of the themes that we're in will continue to be advantaged, like e-commerce and like cloud-based computing and software companies and so on. So they're not going to be the first ones that get hit. We're going to see other sectors get hurt first, probably banks and industrials, which we have virtually no exposure to. The second thing is, so we're going to take our cues there. The second thing that I can say is that when you get a really steep decline, it tends to come because people have become overly exposed to the market. Now, we showed earlier that actually investors are quite bearish, positioning is quite light, and in fact, lots of people are short the market, which is hurting them right now. And so we're less likely to have a really sharp, concerted sell-off because as it stands, nobody or very few as an aggregate are overly invested. The third thing, we run stop losses on all of our positions. So should one or more of our positions start to weaken or even really underperform the market, they become candidates to be sold. And if we hit our stop losses, those positions move away. So for instance, while it makes all the sense in the world to own a utility that pays a nice dividend, they have been underperforming. And so we've been reducing our weights, not because they're so terrible, but because there are better things to do with the capital. So between stop losses, watching our breadth models, which tend to give us an early warning before the big stocks in an index start getting hurt, by managing our positioning to make sure that we're not too overly exposed, all of these things should help. Believe me, I'm the one who is unpopular at times because my focus is trying to identify things that don't make sense given what we think is going on. And I raise those regularly in morning meetings. And if we start to see things that play out, then we'll make a move. But we do reevaluate every position every day. Fundamentally, technically, we review the macro environment, our sector leadership, our theme-based leadership every day. We review the structure of each portfolio every day. So every position for every client is being evaluated every day. And as many of you know, we have no hesitancy in selling first and asking questions later. So I do expect we will get some bumpiness along the way. I think that what is typical is that when you have a secondary sell-off after the first sell-off, and the first sell-off, everything gets impacted. And then after you have a recovery, you have real buying and you have short covering. If you have a retest, the things that were short covering the things that are not quality tend to sell off again. But as the experience in 2009, some sectors didn't sell off a second time because people recognized that, in fact, they were well suited to the current environment. And I would say the groups that we're in now are groups that are well suited to the current environment, whose business models have probably been accelerated by 2 to 3 years, and the change in people's habits that have happened in the last 3 months are unlikely to go back. And so I think that our opportunities are really quite good. So hopefully that's helpful.
Thanks, David. Oh, and one other question here. It has to do with Canada's inflation rate. So Canada's inflation rate turned negative in April. What impact is this likely to have on the markets? If you could just briefly comment on that.
Well, it's something that we don't want to see. As you know, one of the big pockets of loans are mortgages, and the collateral are the houses. And if we get deflation, that means that asset prices go down and collateral value evaporates. And that makes it more difficult for banks to reclaim what they're owed if they have to take back a home. So in the Depression, the value of collateral evaporated, and that's why the banking system got into difficulty. Now the banks today have fortress balance sheets, far, far, far more conservative than they were in 2008. So their ability to withstand a downturn is very significant, but they would be a sector that would be hurt. So the Fed is being very clear, as is every other central bank. Their most important thing is to support asset prices, because asset prices give you collateral and mean that credit can be available. So the Fed's working hard at making sure that there is no credit problem. Solvency may be another issue because many businesses have a hard time operating below capacity and make any money. So that's what we're going to see going forward. Who can make money to reduced capacity? Who can't? Airlines could be difficult. Many of the travel companies could be difficult. Restaurants could be difficult. But remember, the S&P 500 is not U.S. Main Street, right? These are global businesses, many of them in industries that have very little to do with what's happening on Main Street. But those are some of the things to think about.
Thanks so much, David. We have one other question that I'm hoping you can address. Are you concerned about the possible delisting of Chinese stocks in the U.S. market?
Well, I'm concerned about the fact that you have this dissonance going on a global stage. The Chinese are bending over backwards to try and show that they want to live up to this trade deal. As we heard last week, there's real risk of this trade deal unwinding at some point over the year. That would be difficult for markets. We don't have a lot of exposure to China. We have companies that do business in China, some of the semiconductor companies, for instance. So we do think about that. We have a little bit of exposure in macro. We've got some exposure to the Chinese internet retailers and Chinese technology. They had weaker days today, nothing disastrous. So there are things to watch. We just don't really want to see this rhetoric continue to ratchet up. And in fact, that could be something that causes a pause here in the market. We'll have to see. It goes into the mix with everything else.
Thanks, David. That concludes our questions for today. And of course, if we didn't get an opportunity to address your questions on this webcast, we'd be pleased to do so offline. And with that, David, Jim, thanks so much for taking the time. David, any last remarks?
Yeah, sure. We've been doing this weekly. We're looking forward to, we've got a great lineup coming at us. One of the reasons that we did our recent transaction with Roundtable Partners, bringing our new partners there, is that they've spent some time building alternative investment products, things that are not specifically stock market related. And we'll be bringing forward either next week or the week following a session on a fund that we're creating to invest in music copyrights and royalty streams. So that'll be a really interesting call. There are some people who are interested in looking at some things that are not tied to the economy and not tied to the market, and investing in music royalties, songwriters royalties, have neither. They have no tie to the economy and no tie to the stock market. So that's going to be an interesting call. And I think that we'll be doing a call also with our partners that do work in sort of long-range financial planning as it relates to the current environment. So we'll keep you updated as to what's coming next. And if anything changes in between, you'll hear from us. We're going to try and continue to push out lots of content. So thanks everybody for joining us today. We appreciate you taking the time.